Hey, so since most of these things are playing out fundamentally now in the economy, now the only thing we're left with is the United States stock market. Gonna bring up three pictures before I continue. Number one, bankruptcies are playing out. This time they're an uptrend. You might say, oh, there was some shop here between, let's say 2014 till 2020. Sure. Um, but this time it's an uptrend and it's showing no signs of going down, right? Number two, do we have deflation? Yes, we do. Do I think the deflation will continue? Yeah, the quantity theory of money tells us deflation should continue until October, November, December of next year. Because that's when the M2 money supply stopped being contracted. Now you can still have deflation even with a 2% increase in the money supply. You actually need 6% M2 growth rate year over year to get 2% inflation. Number three, do we have a rising unemployment rate? Yes. So I made this picture yesterday. Okay. Now let's go to the unemployment rate. It looks pretty simple to me, okay? If we just take a vertical line here, and again, if I mouse over this, it's gonna say the number here. This is the unemployment rate. The unemployment rate is all about the rate of change, okay? At the bottom of this cycle, before the global financial crisis began, the unemployment rate was 4.4%. Then, by May of 2008, it was 5.4%, a 1% increase. The bottom of this cycle was in April of 2023 at 3.4%. Now, we're at 4.3%, so we've gone up 0.9%, which is comparable to being in May of 2008. If we copy over what that looked like when the spike came, this is exactly how it played out. So the unemployment rate is rising. We have bankruptcies in the uptrend. We have deflation, and we also have delinquencies rising, okay, which is another thing I've been talking about. If we open this, delinquencies are in an uptrend. You might say, oh, but they were going up here as well, right? But again, this is a proper uptrend now. There's no signs of this slowing down, okay? And the reason why I'm bringing these things up is because about a year and a half ago, I wrote all of this down. The inverted yield curve means things are okay in the gray zone. So the gray zone is right here. All right, so let's go to the yield curve real quick. The inverted yield curve is when things are okay. It's just a warning sign though, okay? It's in the gray zone. And it happened in all of these prior examples. You see it's inverted, etc. Right? All of these times where it's inverted. Were things still fine in 2006, 2007, in the beginning of 2007? Yeah. Were they all right in 2000? For the economy? Yeah. For the stock market? No, it was going down. Were things bad in 2019 when it started to invert? And if you want a more visible sign of it, you can go to the 10-year 3-month right there. Right? And then this right here. Are things still fine in the economy during these inversions? Yes. Now, the stock market can have some volatility throughout the inversions for sure, but the economy doesn't start to really collapse until it comes out of inversion, right? Which is what I wrote here, and I wrote this a long time ago. You can see where everything was at this point. You can see the unemployment rate was down here, right? Now it's moved up, right? And basically, I wrote this. The re-steepening of the yield curve is when things are bad. That's the red zone, okay? For every 2% the inflation comes down, the unemployment rate needs to rise 3.6%. Where did I get that from? Well, we'll bring that up as well. I brought this up in a previous video, but I have to bring it up again. So it comes from this.
Put it another way, okay? The economists did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce.
This is what I meant by this, okay? If we go back to the picture, inflation down 2% equals plus 3.6% rise in unemployment rate.
Inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have
So Jerome Powell, maybe he doesn't remember it exactly, but he's pretty much agreeing with this, yes?
been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate 6.4% and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again blame anybody, but if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay.
So he agrees with that.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
It's the same math, but he can't say it.
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play
I mean,
here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute.
So the whole idea, right, is that I wrote this down. Inflation down minus 2% equals 3.6% unemployment rate rise, right? So at that point, in this inflationary cycle, inflation had been 9.1%. And again, this is when the unemployment rate was 3.4%. And when I wrote this, it said in this picture, right? Let's say it's 3% next month year over year. Actually, the unemployment rate was 3.6% here. But yeah, let's say it's 3% next month year over year. You take 3.6 times 3. Why? Because if inflation was 9.1%, and let's say you want to get down to 3%, right? Which we did at that point. However, there's going to be a lag effect in regards to the unemployment rate rising. For every 2% increment you go minus in the inflation rate, the unemployment rate has to rise 3.6%. So you take 3.6 times 3. Why? Because you went from 9.1 to 3% inflation, right? So that's already baked into the cake based on this math right here. Yeah? 3.6 times 3 equals 10.8 plus 3.6, which is the current unemployment rate when I wrote this picture, equals 14.4% unemployment rate just to get down to 3% inflation based off of, I mean, that's just math, right? Now, in order for the inflation to go down to 2%, it's going to have to be a 16% unemployment rate, right? Now, if we slip into deflation, which again, the quantity theory of money tells us, what do I mean by that? This is not my opinion. Like I showed you, we got deflation last month for the first time since when? The beginning of the pandemic recession, right? Why are we seeing deflation? It's not a random coincidence, okay? You can say it is. I don't think it is, okay? And it's quite simple. It's all about what happened to the money supply. This contraction from December 2022 until March of 2024, right? So this contraction right here suggests we should see about 5 to 10% deflation. Now, why is it harder to say how much deflation we're going to see compared to inflation? Because the quantity theory of money that Steve Hanke, the professor at Johns Hopkins University, was citing in 2021, saying that the inflation rate was going to peak in June, July of 2022 at around 9%. It peaked in June 2022 at 9.1%. So the quantity theory of money, again, the exact same thing, got inflation correct. But why was it easier to get it on the upside compared to the downside in regards to a precise number? Because when deflation occurs, it's because something really bad is happening and it can lead to more deflation. And what do I mean by more deflation? Well, if the banks collapse and the deposits go poof and people don't get it back because the FDIC doesn't have enough money to insure your deposits, well, then GG. You're gonna lose your deposits and there will be even more deflation, right? That's why it's harder to estimate how much deflation we're gonna see, but probably about 5 to 10% deflation. That is not my opinion. I'm not predicting that. I'm saying the quantity theory of money tells us that we should see 5 to 10% deflation by the end of next year, year over year. That's what that tells us. Okay, again, not my opinion. All right. Let's go back to the next thing. I wrote trust the yield curve. Odds are nothing is 100%, right? But based off of history, yeah, it's been 100%. Okay. The unemployment rate is in blue. The stock market is in yellow. I wrote here, I am bullish when the VIX goes to 50 to 90. Did we get the VIX spiking up? Yes, we did. Does that mean I'm going to flip bullish here? No, because again, when it spiked in March of 2020, it was the beginning of a down move, okay? Now we went to levels on the VIX, 50 to 90. We went to something in between, only seen in March of 2020, September, October 2008. So I wrote that. Unemployment rate going up, or moons, which it hasn't mooned yet, but it's going up. And I mean, let's put this on log then, to make it even more visible for you. Show me a time when the unemployment rate rises like this and it doesn't continue and leads to a recession. It's not a thing. Okay? It's not going to end well. It doesn't just go up and then it's going to go down. That's not how it works. At this point, where are we? This is where we were in 2008, to make a comparison. May of 2008, it looked like that. Were things good in May of 2008? No, but a lot of people still thought things were fine. By the fall, everyone was talking about the depression. So keep in mind how the narrative shift can happen real quickly. All right? Re-steepening of the yield curve. I should have even specified through a bull steepener because there's two ways for this to play out. But are we getting the re-steepening of the yield curve? Yes, we are. So all the things that I needed to turn bullish are starting to play out now. It hasn't played out entirely, but it's starting to play out. This is the condition. And again, I'm gonna flip bullish on markets when all of the bad things have played out. Am I gonna get the bottom? Absolutely not. Am I gonna buy too early? Probably. What am I gonna buy? We're gonna have to wait and see. Whatever gets cheap. I also wrote down here, patience comes from knowledge. What do I mean by that? Well, you know how this Indiana Jones clip, right? A leap of faith. You remember this one? I'll show you. This is me with the yield curve in 2023. I'm sure you've all seen the Indiana Jones movie, right? In The Last Crusade. Or this clip right here, leap of faith in The Last Crusade. Where he has to believe in God in order to step over this thing, right? And get to the other side to get to the Holy Grail, which gives eternal life, right? This is me with the yield curve, okay? Everyone has been, other economists, the media, the mainstream media, politicians have been gaslighting for a long time. There will not be a recession. Unemployment rate won't go up. We won't slip into deflation. We're going to get down to 2% inflation. It will stop there and unemployment rate won't go up. That's what a soft landing means. A hard landing is the opposite. We will overshoot, meaning we will probably slip into deflation. Well, that doesn't have to happen in a hard landing. It's mainly about the unemployment rate. If the unemployment rate goes up and it goes up too much, well, that's a hard landing. So anyways, the point I'm trying to make right here is this is me in this case, okay? And I'm trying to walk over this invisible bridge, right? And the only way I can get over this is by believing in God. So it's like me right now. The only way you get to the other side of this economic downturn is by believing in the yield curve. This is why it's such a good analogy. Okay, so let's watch it.
Path of God.
Believe in the yield curve.
Only
That's me looking at the charts, right? Looking at the yield curve.
a leap from the lion's head. Will he prove his worth? Impossible. Nobody can jump this.
It's impossible, right? This time it's surely different. Is it not? I mean, you see how the analogy is like crazy here.
Indy! Indy, you must hurry! Come quickly!
It's a leap of faith. You must believe, boy.
You must believe. It's not different this time. You must believe.
You must
I believe in the yield curve, like religious people believe in God. And I'm not trolling when I say that. I'm not religious, but I do believe in the yield curve, like people believe in God. Okay? You believe in the yield curve? Well, guess what? This is the path. This is what ends up playing out, right? You get the re-steepening of the yield curve number one, and then you get the unemployment rate rising like this. Because you believed. The path becomes clear. Was it clear right here when the unemployment rate was down here? No, you had to believe in the yield curve. So that was him. That was him when before he started before he took the step and believed in God and then landed with his foot on the invisible bridge, right? And now, what do we have? A rising unemployment rate. You have to believe in the yield curve like Indiana Jones in The Last Crusade in the clip Leap of Faith. You have to. Do you understand why it's such a good analogy? You have to absolutely believe in it. Anyways, that's all for that clip. So now the question becomes, all right, so most of these things have played out or are starting to play out right now, right? Pretty much everything on this picture. Besides this and the stock market crash, and this is what the video is really about, okay? What about the stock market? It's the last thing that goes, okay? That and the unemployment rate. You cannot price in a recession before it happens because number one, it's subjective on soft landing versus hard landing. So why did the market go up in the past 2 years? Because everyone thought it's different this time. There will not be a recession. So they cranked up the leverage. This time it's different. People are not going to lose their jobs, right? That's why there was no pricing in a recession. You cannot do that. Number two, there's systemic risk. How are you going to price in systemic risk when you don't know how bad it could get? Forced selling from the unemployment rate going up. Okay, so are you going to sell for other people that are going to have to sell because of job losses? You see how this doesn't make any sense? People lose their jobs means they sell stuff to repay debt, food, and shelter. They cut back on spending, they stop stimulating. That hurts earnings, which leads to more layoffs. And then I didn't write that down as well. Eventually, when you start to slip into deflation, what's the problem with that? Well, let's say you want to buy a TV, right? And you're in, let's say, like for an example, like right now, you're in August. Okay, so now in August, you want to buy a TV. And you saw that the price has dropped compared to in June. Okay, and then 2 months later from now, you look again, and the price is dropping again on the TV in October. Then you're like, well, if the price keeps dropping and I don't really need a TV right now, maybe I'm gonna wait with buying this TV. What does that do? Well, there's gonna be too much inventory, so they're gonna have to get rid of it. What are they gonna have to do? Lower prices even more. All right, so you get into a deflationary spiral. All right. Then I wrote mass deleveraging. We have not seen that yet. That's when you get a stock market crash. Mass panic. We have not seen that yet. Bankruptcies. Are we seeing bankruptcies? Yes, they're an uptrend. Delinquencies. Are we seeing that? Yes, it's an uptrend. So everything on the whole picture is playing out right now besides one thing, a stock market crash in the United States. Is that coming? Look at all prior examples. Has the stock market gone down when the yield curve re-steepens? Every single time, yes. Before we continue, I want to go to my Twitter and I wanted to show something. Number one, everyone is all in. Nobody can buy the dip. The crash has begun. This is the dot-com bubble. This is the peak before COVID, before everyone was given stimulus checks. Now I want to differentiate what the difference between QE is and stimulus checks. Okay, QE is the Fed buying treasuries and mortgage-backed securities from banks' balance sheets, and buying treasuries from non-bank entities. So that would mean, what are they doing? Bank reserves is not money. They could make 5 quadrillion bank reserves and it won't impact M2 money supply. How does it impact M2 money supply? If you have a treasury, okay, or if you have treasuries and you sell it on the open market and the Fed comes in and buys the treasuries on the open market, there is a uh, electronical transfer between you and the Fed, where they buy your treasury, okay, or your treasuries, and you get paid or you get money for it, right? That increases M2 money supply. Now that you have money that can flow into risk assets, okay? That's how it flows into the stock market. That's how it flows into the stock market and eventually things like crypto, for example. Okay. Now, who has treasuries? Who is more likely to have treasuries? Okay. Who is more likely to have treasuries? Not the average person, probably, who spends more than the ones that do have treasuries. Okay. What do I mean by that? So here's the difference, right? If you do CARES Act 2.0, stimulus checks 2.0 through fiscal policy, okay? Meaning money is lent into, no, um, the US government borrows money, which expands the national debt. This has to be paid back through higher taxes. That money, stimulus checks, is then given to the average consumer. 70% 70% of the US economy is the consumer. So if you give them money directly, it's extremely stimulative. Make sense? Because these people that are given the money through the CARES Act, the stimulus checks, are more likely to go and spend that money in a way where it's stimulative for the economy and it's extremely helpful compared to going in and buying treasuries from the non-bank entities and giving the money to people that are less likely to spend it. Now, yes, that some of that money will make its way out to the average consumer in various ways, absolutely, but it's not going to be as stimulative directly. Indirectly, it could be in some ways, but it's still not going to be as effective. That's my whole point, right? Going back to the stock market, objectively speaking, is the Nasdaq in an uptrend on higher time frames? Are we in an uptrend on the monthly and the weekly? Yes. This uptrend is absurd, right? Has the stock market in the US crashed? Well, it's down quite a lot in the past month. It went down 17%, but that's nothing really catastrophic given how insane the pump has been since 2022. Now, why has this happened? Because these people believed in a soft landing. Okay, there was not going to be a recession. In the past 2 years, bad news has been good news because the narrative in amongst market participants was that the Fed is going to ease. Okay, ever since this whole period, right, in this uptrend, that was the case, and even in this downtrend right here. But what do we have right here? A narrative shift. What happened on July 11th? July 11th, deflation. What pops a giant bubble that has been inflated? Deflation. What does the M2 money supply tell us? is coming. Way more deflation. I am not saying we can't make a new all-time high in the stock market. We could. We could even make a new all-time high in BTC as well in that case. BTC will follow the stock market. In 2007, the first rate cut came on September 18th. The market rallied into the first week of October, 3 weeks after. It is possible to make a new high going into the first rate cut. Do I think that's going to happen? I don't know. Objectively speaking, are we still in the uptrend right now in the stock market? Yes. Do we even have a bullish technical sign right here? We have a lower low on the momentum indicator, but a higher low on the price in regards to candle closes. Because again, it cares about the candle close, right? That's a hidden bullish divergence on the weekly. That could lead to one more bounce going into the rate cut, which could lead to a new all-time high. Do I think that's gonna happen? I don't know. It's about the narrative. What happens in the next couple of CPI readings? Because from now on, I think every CPI reading is going to be deflationary. Can I guarantee that? No. And even if they come out with, oh, it was 0%, maybe we actually got deflation, but they don't want to report it. There is an incentive for them to not do it. Why? Because if they report deflation, it's actually very bad. Because you'll stop spending. Because again, like the TV analogy that I brought up, if you know the price is going to go down, you're less likely to spend, which will make the problem even worse. Inflation, by definition, is not actually a rise in prices. It's actually all about the money supply. It's the increase in the money supply. Deflation is the opposite. Deflation will be a contraction in the money supply. Over the long term, in a healthy economy, on a with a sound money system, right? Then you would have that type of environment, right, where those definitions would apply. However, in the current clown world we live in, even getting below 6% empty growth rate year over year could lead to you going below 2% inflation and potentially slipping into deflation. That's the problem, right? So is the stock market in a very, very severe downtrend now? The US stock market? No, it's still a very strong uptrend, right? It doesn't matter what my opinion is. Yes, the economy is going to shit. Bankruptcies, deflation, and the stock market is down bad since this point, right? And also the jobs report. The jobs report came out right here on Friday, right? Right there. So we sold off with the deflation reading. We sold off with the unemployment rate report, right? Now you can say, oh, it's because of Japan as well. Sure, but Japan reacted to that bad jobs report as well, right? So is the stock market bubble over right now? It's too early to tell, right? Am I gonna sit here and say the United States stock market has topped right here? I don't know. It could make a new high. I have no idea. The reason I'm bringing this up is because yes, we do have the economy slipping into recession very clearly here. I mean, you can't even deny it. And everything in this picture is playing out so far, besides the mass deleveraging and the mass panic. That is the only two things that we're waiting for. Everything else on this whole picture is playing out. I wrote this a year and a half ago. Everything else is playing out. Because it's a scripted business cycle. It's never different. It's just that simple. Really, it is. But bear markets can last for a year and a half to 3 years, right? The dot-com bubble was from March of 2000 until July of 2002. The global financial crisis was from, well, that market crash, right? The bear market was in 2007. It was from October 2007 until March 2009. A lot of things like Apple, for example, bottomed in October 2008 with the VIX spike. So blue chip stocks can't. Microsoft bottomed in March 2009 though, right? Silver and gold bottomed in with the VIX spike, and it went up before the stock market started to do that, right? But is the stock market in a catastrophic downtrend right now? On the 4 hourly, yeah. On the daily, it's starting to look shaky. On the weekly, are things still fine? Absolutely. So we got our main objective here. Let's look at BTC. Okay. What about BTC? Where do we bounce? The ETF sell-off. From a technical perspective, does this still look fine? Sure. With what we have right here, is there a possibility we make a new all-time high? Sure. Do I think that's likely? No. But is it possible? If the stock market does, then yeah, it is possible. And in fact, in that case, it's probably even, well, it's even more probable, right? Where BTC starts to get shaky is if we take out that level. Now you're confirming a downtrend on higher time frames. Okay? So as long as you hold above 49k, the daily might look terrible in some ways. The weekly still looks fine. What about the Nikkei? Has it recovered since this 30% decline here? Yeah, sure. It's bounced back up. Is that going to lead to a new all-time high? I don't think so. I think this one is over, right? We're going to have lots of volatility. Lots of volatility. Now I want to go over into a couple more things in my Twitter feed, right? So again, a lot of these things were easy to see in advance. Anon, is your stop loss below there? Good things won't happen below 2800 underneath. Anon found out. I mean, when you have 1, 2, 3, 4, 5, 6, 7 equal lows, I think we're gonna go for round 2. What did I say? I think so in a few days or weeks. Because we did the same, now built did the exact same idea, right? Below 2100 here. Okay? Same thing on Litecoin. Anon, is your stop loss below those lows? They found out. You can go to my Twitter. I post charts and so on publicly. Here's another thing. This is my intuition. Again, I'm not saying, oh, guys, I called this, blah, blah, blah. No, 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 fuck that. I just wrote this because it was interesting. This was the DXY on the weekly in September, October 2022. And it looked like this. And BTC looked very similar, right? On the weekly. And I was like, this kind of reminds me of DXY. Keep in mind, Trump said, good luck with your Bitcoin or crypto, whatever you're playing with. Never sell your Bitcoin. Bitcoin is going through an Elon Musk 2021 vibes on Saturday Night Live. DXY daily versus BTC weekly. If BTC fails to make a new high, there it's gonna be ugly. Hold below 60 and it's all good. Break below 50 and it's truly the end, right? No one could have seen that one coming. But that was my intuition, right? Was that based over like, you know, what I thought was gonna happen? Not necessarily, right? Okay, so let's bring up some more things here. This is still the high. 4.236 extension rejection is so bad. You don't get it. You will in a few months. That's the day of the top, right? But I'm not gonna sit there and say, oh guys, look, I call the top, right? And like again, because like I want to be clear, right? I have no problem admitting if I'm wrong. I did not think we were gonna break up here. We broke up, right? So me sitting and saying, oh guys, I call the top, yeah, but also I said I didn't think it was gonna go through here, right? Well, it did. So like that's irrelevant. This is not about ego, bro. Okay, it's not about that. But I'm just saying that was a serious resistance level, the 4.236. You're laughing now, but you won't be. The 4.236 extension was high for BTC, and it will not take it out this cycle. This is my belief still. It will follow the stock market below the COVID lows. Well, that's if we get the Great Depression, yeah. Which history tells us is likely. Not my fault that the COVID lows are at 3k. It's going to 3k. You will not be laughing, right? Look what we did here. Darth Maul candle up, wicked up to the 4.236 extension. Within 0.03% on asset that goes up to 2300%. Closed right below the previous wick. Formed a weekly bearish divergence later. I'm just saying. And it follows the Nasdaq, right? So the whole idea, right, is basically, uh, and you know we've had this with many things as well, right? Uh, where is it? INJ. 200 days acted as good support, but the multi-month range is breaking, not looking good if we take out the 200-day in INJ. Then it goes minus 90%, 28, right? It went down 50 or 60% from here. Boom, capitulation, right? And then recently went down to like 12 or 13. But it's just because there's so many people that have the same invalidation, they all get fucked, right? My point is I don't know where the stock market tops. I think things don't look great, but on the daily time frame, on a lot of things, but on the weekly, everything is still an uptrend. Okay, so the uptrend on the weekly, the delusion amongst market participants that this is going to be a soft landing is still in play. I think what's required is a few more unemployment rate report increases, and if we keep seeing deflation. Again, the market topped on the deflation reading, and it sold off more right here on the unemployment rate report. You might say, oh, well, when they cut rates, it's really good. Really? This is the 2-year yield. This is what the Fed follows. Did the stock market like it when interest rates went up? Yeah. Stock market up when it go up, right? Stock market up when it goes up. What has happened recently when a 2-year yield in orange has collapsed? What's happened to the stock market? Straight down. So you might say intra-caster bullets. It's right here in front of your eyes. Same thing right here. What about BTC? BTC went up right here when the orange line went up. That's interest rates. That's the 2-year yield that the Fed funds follows. What happened when the 2-year yield in orange collapsed? Well, BTC has rolled over, especially here when the 2-year yield started to crash vertically. Right? You can see what happened to BTC. Because again, interest rates are about growth and inflationary expectations. I've always talked about this. It's not a bullish sign. Okay. Now the last thing I want to get into, right, is has Warren Buffett inverted the yield curve? Yes. Look at this. I went into this in my last video, but I didn't specify this like really clearly, okay? On October 16, 2008, he wrote, "This is my personal account I am talking about, in which I previously owned nothing but United States government bonds." What is bonds? Well, in the bond market, a 1 month to 1 year period is a T-bill. A 1 year to a 10-year period is a T-note. A 10-year to a 30-year period is a T-bond. What did he say? I previously owned nothing but United States government bonds. Nothing. He was 100% in United States government bonds. What does that do? How does the yield curve invert? Because the 10-year yield slips below the 2-year yield. The yield curve is the 10-year yield minus the 2-year yield. How does a long-term interest rate go down below a short-term interest rate? Because people are buying the 10-year treasury. What did Warren Buffett say? He was all in on government bonds. What does that tell you? Warren Buffett told you that he was all in on government bonds right here before the global financial crisis. Warren Buffett was a part of who inverted the yield curve and warned you of 2008, the global financial crisis, through his financial positioning. Make sense? Do you understand why the yield curve is always correct? Let's read the next sentence. This description, however, leaves aside my Berkshire Hathaway holdings, which are all committed to philanthropy. Philanthropy. So even though it's all about philanthropy, he still sold half his Apple stake and has $250 billion. He sold $84 billion of Apple shares and has $250 billion in cash. Do you see now how the yield curve inverts? He inverts it along with other billionaires when he buys bonds. It's 100% of his account in his own words. So then he's a part of what's inverting it through his own financial positioning. So let me be clear, by saying the yield curve is wrong, you're betting as Warren Buffett not only in the stock market, but also in the bond market. Think. This is why it's the same cycle every single time. When the yield curve comes out of inversion, like every time, yield curve re-steepens, unemployment rate goes up. 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 Yield curve re-steepens, unemployment rate is going up. I think we still have some delusion to go in the stock market where some people are still going to hold on to the soft landing narrative. That's why the stock market has been going up. Have I been wrong about the stock market going up? Yeah, I did not think it was going to go up this high, right? But I also admitted on BTC, for example, last year when it broke out that, oh, well, I was wrong, right? I made videos, go back and look. October 24th last year when it broke out above that range, that 7-month range. I admitted I was wrong on price action. But with the economy, I'm right about everything. So I'm right entirely about the economy, which is going to affect the stock market. But I was not right about the stock market timing. Why? Because I'd never believed in a soft landing. I believed in the yield curve being correct. Historically speaking, all gains during yield curve inversion rallies get wiped out. Why? Because it was all built upon a soft landing narrative. That soft landing narrative has to get priced into a hard landing reality. Okay? So from a technical perspective, most assets look fine on higher time frames. But I don't think they will in a couple of months because you cannot maintain a bull market with a severe economic downturn. It's not possible. So that's all for this video. Take care, peace.